Welcome to another VC Wisdom podcast. We have Joe Schorge with us. He is founder and managing partner at Isomer Capital. And we're going to talk obviously about VCs. We're going to talk about startups. We're going to talk about tech in Europe, most specifically, which is a cool ecosystem. Really eager to get into it. This podcast is brought to you by podbuyer.com. If you want to start, scale, be invited to podcasts like this one, find sponsors. Podcasts are amazing for learning. I was telling Joe that I don't read books anymore. I just have this podcast and 15 CEOs that I talk to on a daily basis, and that's great for my brain. I also grow my network. I grow my network too because I get leads and clients from this podcast. So podbuyer.com if you want some help starting your own pod. Joe, I am glad to have you on. Can you tell us a bit more about yourself and Isomer?
Sure. Thanks for having me, Charles. Great to be here. Myself, I grew up in the U.S. originally, and I started my career in the U.S. and then I moved to Europe in the late 90s. And I've done kind of three things. The first being a tech guy myself, studying computer and electrical engineering, and then running IT departments at banking and manufacturing companies. Then I did an MBA in London and learned about, got bit by the venture capital bug, worked on some startups that didn't work, learn the hard way, which is a good way to learn, and became an investment advisor at Cambridge Associates, which was really interesting to have, very interesting clients with deep pockets and a global outlook. So investing in lots of funds all around the world. I then went and worked for a private equity secondary fund. And as I was doing that, really, Europe started to take off in the post-financial crisis years in venture capital and tech terms. And I had the idea to start Isomer, which is based in London, focused exclusively on early stage digital tech. We do three things, really. The first thing is we are an LP in seed funds all around Europe. We do that in order to have eyes and ears everywhere. Europe is a very diverse place, and the first professional money into companies is always from the local pre-seed seed fund. We then co-invest in companies together with those same VCs as those companies grow up, and we further then buy secondary pieces of funds or of companies.
Right. And tell me about these first startup failures of yours and the lessons you derive from them.
Oh my goodness, that's we need a series for that. How could I summarize it? I guess I had worked in business, and I knew something. I had software development teams that I managed around Europe, but within big corporations. And you can apply that skill of building software. And of course, what's a startup is really just building a product, but not within a company, starting a new company and selling it to the world. So that was a very natural thing to be able to work on for me. But what I learned kind of the hard way is it's not ultimately really about the tech most of the time. It's about the business you create, the customer that you're trying to create value for, and their willingness to pay for your product. So probably the biggest lesson, I really started as a technologist. I was like the kid building model airplanes in the basement and, soldering stuff and burning my fingers and whatever. And I had as many technologists do, I had a way of falling in love with the tech and loving it and saying, well, if you could only see how great this bit of code is or how great this software is, you'd love it too, And that's actually not how you create a business. So the biggest learning for me is start with the customer. What do they need? What are their problems that you're going to solve or improvements to their business? And then develop the product, which is kind of obvious thing to say. It's what every VC says, but it's often hard for people who start on the tech side to learn that. And that, ultimately led me to investing and to kind of means today that when we look at something to invest in, we always think about what can go wrong. Because as a team, we kind of seen it all go wrong at some point. And, you need a bit of luck, you need a bit of tailwind, you need a lot of hustle. And, but you also need, any mitigant you can build in or downside protection you can think about as you're building something or investing in something.
And tell me about Isomer. Basically, last time we said that it was a fund of funds, and you were like, "Yo, I'm not sure if this VC podcast for me because yeah, this." But I was like, "Yeah, this is perfect." I don't often get these on the podcast, so tell us about the model behind the fund, and also tell us about the expected returns and how they differ from normal VC funds.
Sure, sure. Well, the model, I invested in a lot of the best fund of funds around the world. That's a pretty mature industry, and there's a range of strategies they used. But what we've done at Isomer is to really take some of the learnings from that, some of the best practices, and apply it to this market where there weren't really, at the time we started, there weren't really people doing what we do. And the reason we did it, reason to create it at all, was that Europe is a far more diverse place than the US. So, the venture funds in the US, they're all clustered in about 3 places. I'm going to do a disservice now to lots of people great people in Boulder and lots of other, but, broadly speaking, New York, Boston, Silicon Valley represents the majority of the market. The European landscape looks very different. It's 44 countries. There are 100 cities with unicorn companies in them now. And that was really unthinkable 15 years ago. But what it means is, as an investor, if you're going to go to the US, you need to spend a lot of time in Silicon Valley, a lot of time in New York, a lot of time in Boston. Whereas in Europe, this is like an impossible task. How can you be in 30 or 40 cities, the ones that matter, in a reasonable amount of time? Either you dedicate your whole career to it and you have a team like we do, it's a big job, or you just make a couple of picks and hope for the best. So our idea with creating a fund of funds was it's what we used to call a hybrid fund of funds. It puts 2/3 of its money into other funds and uses 1/3 of its money to do more with those same GPs. So co-investing in their breakout companies as they start to grow, and the VCs running out of money, they're putting a round together and saying, hey, we're doing a 20 million round, and existing investors are taking, say, 10 or 12 or whatever. And that means there's 6 or 8 million, 10 million left. Are you interested? So part of the reason we run this fund of funds is the normal reasons of fund of funds, to have a very diverse portfolio, a kind of all-weather portfolio. There's always something winning in the portfolio. There's always something losing, but you do see the power law, take effect, where the winners are very productive and outweigh the losers. But then if you can double down on the great companies together with your partners, and then even the third thing where you get an LP that wants to leave a fund, one of our fellow LPs, we say, okay, no problem. We could, if we're interested to buy, we could make a price for you. Or sometimes founders leave companies. We'll buy founder shares. Sometimes even VCs leave firms. Now, we had one case where a VC was leaving to start a new firm and needed cash to fund that. So we said, great, we'll buy some of your carry in the funds and some of your GP commit that you've made in the past. We're already in the funds. We have all the data on the companies. We're very close with the remaining partners. So, in a way, fund of funds was not a goal of being arm's length in the market. It was quite the opposite. Goal was, how do we get really close to companies early when it's 2 guys in a garage? And, to bring it all back around, each of those 3 kinds of transactions has a different risk return profile. When we invest in a fund, we want to see, how can we get 3x net out of a VC fund? That's tough. That's harder to do than it sounds for VCs, but that's what we're underwriting. We focus on small funds. They have a mathematically higher probability of achieving that, and they do more often. When we do a co-investment in a company, we're looking for more like 4 to 5x. How can we, if we can underwrite a growth curve and an exit, and look at what we're buying in today, can we see 4 to 5 times money at an exit foreseeable for that company? And then with secondaries, it's more like there's a bit of a dial you can turn from IRR and multiple. So if you buy, say, a very old fund, 8-year-old fund, you can see and expect that it's going to exit soon. So you say, well, I'm going to not have a high multiple there, but I'll get the cash back quickly, and that'll help the rest of my program. Or on the other end, if you're investing very early, you're going to have a long hold period. So the multiple you'd want to see is quite the same as an early stage investment. So what does that all mean in terms of money? On our level, we tell our investors 2 to 3x net to the investor, which is a bold claim when you have such a high. We have 1,000 companies in our portfolio, so to generate 2 to 3x net, which is kind of what direct funds do more often than not, that's pretty exciting, pretty low risk and pretty good return.
So you have 500 million invested yet, is that right?
Yeah, across our different funds, yeah.
So you're aiming for 1 to 1.5 billion returns ish in the next couple of years. What time frame would that be with the current macroeconomic climate and environment that we're living through right now?
Yeah. Well, that's the $1 million question, isn't it? You know what we're seeing on the exits?
$1 billion in that case.
Yeah, the $1 billion question. We had a few exits this week, so I'm feeling, as we talk here on Friday, I'm feeling quite buoyant. We had a SPAC, we had an IPO, we had some exposure to Instacart, for example. And we're in so early that any kind of decent exit, it doesn't have to go out top of range, but we end up having a good, strong multiple. So I'm feeling oddly good, although, to be fair, exits have slowed down a lot. I mean, as you know, through the second half of last year and this year. Having said that, most of our portfolio is B2B focused. It's a lot of companies that you won't read about on the newspaper. They're not big consumer plays. They're more things that big corporates need to buy, either to improve their processes or to build their own customer bases, to get them into a different segment, to digitize their business. So there's an awful lot of exits that no one hears about, which is, big company X buying little company Y. That's happening quite a bit. The other thing that's interesting feature of this cycle is a lot of buyout firms, private equity firms are buying our companies. And that's, again, quiet. Nobody really talks about it. But when you have a high growth company, these are big funds kind of picking up where VCs leave off in a way. And so we've had some really good exits there where, all cash. And sometimes you even have an option to roll. If you think the growth continues, you can keep a bit of equity in from time to time. And then the IPO window's been firmly closed. That's starting to reopen. But I think the bigger answer to your question is the earlier you invest, the longer the hold period. So if you're a seed stage investor, you're going to hold these companies 6, 7, 8 years on average. You maybe can sell a bit early into late stage rounds or in secondaries, which I think is great if you can take some risk off the table. But there's no way around the fact that it takes time to build companies.
It does. First question I wanted to ask is, have you tried the classic VC model before coming up with that innovative VC model? And why are we seeing so few VCs innovate in terms of their business model? George, I think I lost you. Let's see when we come back online. All right, so we're gonna wait for George to come back. Just gonna comment on the last couple of things that I said George. That's funny. It's Joe Schorge. Basically, yeah. What's quite unique here about Isomer, from my own analysis, George. I will have to probably check that one out. But Joe here is, and hopefully I won't call him George when he comes back, but Joe's a deep thinker. We don't often see that in the VC world. The man manages $500 million at the moment. In Europe's probably one of the biggest fund, and the cool thing, the innovative thing, is that he deals with VCs. And if you've listened to him talk a bit earlier, like VCs that invest directly in founders, they're aiming for 10x, right? And Joe is aiming for 3x and 4x, meaning that when VC funds do well, that's the amounts that they get. So when you think about it, VCs, most VCs, classical VCs, don't return that much. As a business model, yes, the volume is bigger, hence the returns, this volume is bigger, so that would be a goal, but the investment is also bigger. So imagine you invest like $1 million. Well, first you need to have that million, then you get $1 million back. If it took you a while to create that million, then sure, it might be worthwhile. But the main lesson here is that most VCs first don't return that much. And yeah, the 3-4x that he's mentioning here, let's say that he reaches it in 50 at worst, 75% at best of his investment. And I think it's, being a fund of fun is great. It's just like, people talk about Mr. Beast nowadays, but they should talk about YouTube as a platform. Mr. Beast is just a cog in the wheel. He's feeding the big machine here, which is YouTube. That's the kind of stuff that I want to build. You always want to be on top. You want to be the back end, the baseline of pretty much everything out there. So I think it's a super smart model, and I'm eager to ask more question to Joe about like all of his strategies for this year, because as we're seeing, it's not a super easy year. And Joe is joining back. Earth to Joe. Let's see if the connection is back here. Test 1, 2. Joe. Let's see if we are back. Camera is back. Joe is back. Everything's back.
We have a big storm outside, so we lost network. Sorry for that.
Where are you based again? London, right?
I'm in the Netherlands.
Netherlands, huh? Very cool. So yeah, just to pick up like where we left, I was asking you if you, and by the way, I called you George in your absence because of Joe Schorge. I'm pretty sure I'm not the only one doing that. Let's tell my brain to not do that. I was asking, your VC model is quite innovative, and we're not seeing that quite often. I feel that most VCs, it's like the classical fund. Maybe they have a unique thesis, but have you tried the classical VC model before going for the fund of funds model?
No, quite on purpose. So there are lots of great funds in Europe. We have met so far just a little over 1,400 VC firms in Europe, and they're all managing 2 to 3 funds, say. So why does the world need another fund? It doesn't really. You name your country, and I'll tell you a great fund there. Rather, there's a position we play in the market which is different and adds a different kind of value. So we help a lot of new emerging VCs get started. I like to think we help them drive better outcomes and more value. The proof will be in the returns and in what they say, not what I say. But part of why we do what we do is there's not anyone who really sits between big institutions that would like to have an exposure to European early stage tech, but it's a very difficult thing to do. As I said, there's there's not 2 cities, there's 30 cities at least you want to cover, and 100 cities with unicorns. So we developed this model really as a way to say, hey, if you're a big investor, maybe you're a pension fund or a family office or a corporation or whatever, we can give you a window on Europe that's very broad. Because it's so diverse, it'll be a lower risk profile. So you may or may not have an ability to pick one or two funds, but we'll help you with that. And what many of our LPs do is they kind of learn through us. They start to meet, oh, I really love what's going on in Eastern European deep tech. What can I do there? Like, can I do some co-investing? And so we take that as part of our job, develop a broad exposure, develop a great return, but then help our LPs build their own portfolio around us. And that's a pretty special position in the market. I love it. It's really fun, I have to say. And we're different, and come back to every time I meet a new fund manager, I think to myself, sometimes I ask them out loud, why does the world need another fund? And if the answer to that is you have a superpower or you have a special thesis, great. If the answer to that, I just want to have a fund, yeah, I'm not sure. So we need to work to create value every day and to drive value for our investors. And so we found a unique way to do that.
Closing off here, and I'll selfishly want to run two with you and 24 because that was not nearly enough time because it's quite interesting what you're building. But in Europe, we're seeing green tech, climate tech leading the way worldwide, I think it's fair to say. But we're also not seeing the hyper growth that we often see in Silicon Valley, for example. So tell me about the European trends and the edge that Europe can have over the rest of the world in some sectors.
Yeah, that's an important question. Certainly, I think Europe is leading in climate tech, in ESG, and a number of areas like that. And we have invested a bit. We're cautious. Of course, we want to improve the world, and we'd love to do more, but we are ruthlessly commercial. So, we've invested in deep tech climate, and I don't think venture capital is appropriate for climate solutions that'll require high amounts of capital and so on. But boy, it can. So I don't necessarily want to generate the power, but if I can write the software to manage it better, or help with storage technologies or whatever. So that's where venture capital can play a role, and we do. I don't necessarily agree with you on the hyper growth point. There are some benchmarks like Cambridge Associates where European venture returns are higher than U.S. venture returns, and that's taking an average in using their data set. But there is a lot of hyper growth. We have fund managers delivering 5, 10, and 15 times on a fund level. That doesn't happen much. It doesn't happen anywhere much. But there is hyper growth. The areas where I would say Europe has an edge, fintech. I believe London is the center of the world for fintech. If you look at how the banking system is working together with technologists, I always laugh when I go to the US because it's 10 years behind, honestly. We haven't written a check here in 20 years. I don't even have a checkbook. My bank doesn't give me a checkbook, right? It's all digital. And so entrepreneurs are building the next layer, which is interbank trading without using the card networks, which is new insurance models, all kinds of interesting things that if you have digital rails behind, you can start to innovate on the business model above. Other areas where Europe leads, gaming. A lot of the top game companies have come out, Clash of Clans and Angry Birds and stuff like this, all out of Finland, which really punches above its weight in gaming. Cybersecurity, a lot of really good stuff coming out of Europe, the world leading. And the funny thing is, a lot of companies that are European, they go to the US and they position themselves as American companies. So you may not even know it's American. Spotify from Sweden, probably a good example, right? I don't know if Spotify, I don't think it tells you when you're buying the product in the US that this is a Swedish company. It's just a music streamer, right? It's in the same way that people here, when they subscribe to Netflix, they don't necessarily know it's American. They just know it's a nice service. So there's a bit of an effect of that as well. Lots of companies want to appear local when they launch in other places. There's a big push in Europe for deep tech, space tech. There's a lot of interesting things going on in that area. I understand one of our companies is a microsatellite company. I understand one of their top customers is the US government. Right now is a very important moment to have eyes all over the world on what's going on. And so a lot of tech behind the scenes that you wouldn't necessarily know is European. The tech is not, as I like to say, it's not a national sport. If you build a great piece of technology, it doesn't really matter where it could have come from Boston, could have come from Prague, could have come from Madrid. I mean, who cares? What matters is we can use it and do something great with it.
Love it. Well, thank you, Joe. I won't call you George. Where can people find out more about you?
Well, we're pretty visible on isomercapital.com. I mean, we just put a little billboard up there to tell what we do, but we're all on LinkedIn, pretty easy to approach. And yeah, we love to meet anybody who's looking to invest in European tech or anybody already investing. We have a pretty broad network, and yeah, get in touch. I'm js@isomercapital.com. Easy to find me.
And I am Charles Cormier, your host at VC Wisdom Podcast. That was Joe Schorge.